Thank you for joining us this Friday, the 11th of February. I'm Sophia, a market analyst with Bell Direct. Well, today we'll cover the opportunities in the hydrogen industry, stocks to watch, and this week's reporting season highlights. But first, let's take a look at the week so far. The ASX 200 has rallied 2.36% Monday to Thursday, with a rebound in tech shares, which have gained 5.8%. However, the ASX is falling today as data reported overnight saw US inflation hit a 40-year high. On the ASX 200 leaderboard, travel stocks finally made gains. Webjet, WEB, Flight Centre FLT and Corporate Travel Management, CTD, led the market after news this week that Australia's border will open at the end of February. Open borders will signify a welcomed increase to cash flows in the sector, and investors jumped in. Meanwhile, Nanosonics, NAN, dropped the most this week following the surprising announcement that they'll revise their current sales agreement with GE Healthcare. GE has played a large role in the success of Nanosonics in North America. Bell Potter upgraded their recommendation from a sell to a hold and decreased their price target to $5.50. Meanwhile, Goldman Sachs retained their sell rating and decreased their price target to $3.80. On the All Ords, Centria, CTT and Seven West Media, SWM, were the top performers, while Advanced, Zintech, ANO and Lay-By Group, LBY, both dropped 20%. The most traded stocks by Bell Direct clients included Rio Tinto, RAO, Champion Iron, CIA, Qantas, QAN, BHP and MMA Offshore, that's MRM. Clients bought into Coles, COL and Westpac, WBC, while took profits from Fortescue Metals, FMG, Lake Resources, LKE and Star Entertainment, SGR. Now moving on, the global economy is aiming to transition to net zero emissions by 2050, and hydrogen is an emerging alternative low emission fuel source. Now, because of our wind and solar energy resources, Australia is in a strong position to be able to develop a hydrogen export market to the Asia Pacific region. Australia is the closest potential exporter to Japan, South Korea and China, who have already pledged to reach carbon neutrality, and Singapore, who are developing a sustainable hydrogen supply chain. Now, many countries are aiming to transition away from fossil fuels, which has sparked global interest in hydrogen. Now, yesterday, ANZ released a hydrogen industry handbook to further educate Australian companies on the industry so that businesses can grasp the opportunities in the market and aim to profit from the growing demand for hydrogen energy sources. So, who are the players involved and what are their plans to achieve this? Well, two components of producing hydrogen are one, the cost of renewable energy, and two, electrolyzers. Electrolysis is the use of an electric current to drive a chemical reaction. So electrolyzers are used to split water into hydrogen and oxygen. Now, with this in mind, Fortescue Metals, FMG, is a stock looking to expand into this industry. Fortescue Future Industries is building electrolyzer factories. In a few weeks, they'll commence construction of a $1 billion manufacturing plant that will start producing electrolyzers at the beginning of next year. Another stock is Wesfarmers, WES, who replaced fossil fuel transport with hydrogen-powered vehicles. Now, interestingly, there have been fast declining costs with the rise of hydrogen supply. On Tuesday, Goldman Sachs reported that by 2030, the increase in supply will drive the cost of electrolyzers 55 to 65% lower. Additionally, there is also an opportunity for hydrogen to support Australia's coal industry. So just last month, Australia shipped the world's first ever cargo of liquid hydrogen produced by a brown coal mine in Latrobe Valley in Victoria. Now, some other ASX listed stocks with hydrogen exposure include Global Energy Ventures, GEV, Lion Energy, LIO, and ADX Energy, that's ADX. Okay, now let's take a quick look at reporting season this week. 58% of companies that have reported so far beat expectations, and 23% are in line with expectations. So Champion Iron, CIA, exceeded expectations, reporting solid operating performance with production and shipments remaining above the Bloom Lake Phase 1 nameplate capacity, albeit higher freight rates impacted on earnings. Commonwealth Bank, CBA, also beat expectations with higher revenues, lower expenses, and a provision return. And in case you missed it, we released a full report on CBA's results, which you can find on our YouTube channel. Now, Bell Potter say CBA is a buy, while other brokers aren't as positive. An outperform rating by Macquarie and Credit Suisse, a reduced rating by Morgans, underrate by Morgan Stanley, and a sell by Citi. And computer share, CPU, also beat expectations. Macquarie and Credit Suisse have an outperform rating on CPU, while Morgans have a hold rating. And lastly, economic data to look out for next week includes the RBA's meeting minutes and home sales data released on Tuesday, and January's unemployment rate will be released on Thursday. Now that is all for this week. I'm Sophia Mavridis with Bell Direct. Have a great weekend, and I'll see you on Monday morning.